Welcome to this week's edition of the Mentor Club. This is Noah Davidson. I'm flying solo. It is January 27th, 2020, and I'm looking forward to this session. I did a couple different things here that I think you'll really like, but before we get started, let's go ahead and jump into our disclaimer real quick. And again, make sure that we cover this appropriately. It's important to note that, again, this is a game for grown-ups. We want to make sure that we highlight and point out that, one, this is for educational purposes only. And two, no warranties, no guarantees. We're not going to talk about, what kind of money or returns you can make because, the sky's the limit. But the truth be told that, it takes a lot of time and effort to get good at managing, controlling the risk. And again, all trading and investing does involve risk. And in fact, today's market's a really good example of that risk on environment. We're going to be talking about that. And what I did today is a little bit different because the markets had a really sharp reaction over the weekend due to the coronavirus coming out of China. What I did here is I actually went in and I recorded a segment right at the opening bell. So I got on about 5 minutes before the opening bell. And then I recorded my initial portfolio management, trying to react to the market in real time. And I fortunately had the foresight on Friday to put on a hedge, which you'll see. And I'm just going to walk you through how I went through and managed the portfolio. And a lot of it came on, the adjustments and locking in gains and things I did on Friday as the market first showed us signs of some selling pressure in response to the news out of China. And I had my suspicions that it might get, a little bit bigger or worse over the weekend. So I started neutralizing the portfolio. So you're going to see that. We're going to go through that first little opening part of the bell, and that takes about 40 minutes or so. And then we'll finish up with a different segment where we'll talk about some ideas and, ways to make sure that you're prepared for when the market dips like this again, so that you have an idea of a good little action plan and things that you can do and, kind of how to keep a level head, et cetera, et cetera. So we'll do the two different segments, and I think you'll really enjoy this week's Mentor Club. Let's go ahead and dive right in. So we're sitting here in front of the market just a little bit over 5 minutes before the opening bell. And the futures have traded down dramatically. The whole market down dramatically overnight on the news out of China, the coronavirus spreading is spooked the market a bit. And so we got a really awesome, valuable opportunity here to talk about managing the trade. Now, I fortunately had the foresight to start hedging the portfolio on Friday. In fact, had an early attempt to hedge the portfolio on Thursday, got stopped out, had a minor expense on the futures on the hedge cut. It was, I want to say, $260, $70, something like that. And happened to get triggered in as it broke down. And I can actually show you here on the monitor page. We have futures contracts, and I've got two futures contracts I legged in. And cost averaged into the position as it started to trigger and drop. So I'll show you that position in a minute. And I also went and bought some gold futures in the process, and both of those are doing, very well. Now, we're hedging off the rest of the portfolio, locked in some gains, took some option assignments over the weekend, had some other options expire. So I'm going to walk you through the portfolio and just kind of show you how we are going about protecting it. So first things first, let's start out with the risk profile on the futures. And I got cost averaged in between the two trigger points. The first time it triggered was at 3307-ish. And then I got triggered in a little bit closer to 3,300 even, and ended up getting averaged in here at 3,304.75 when I average out the two contracts. So the break-even point is at 3,304.75. So Let me go set a price slice to break even. We'll set that price slice to the chart. And that's really right as it started breaking down. Let me take you back intraday and show you where it caught my attention initially. Is again, with the market breaking down the way it did, I happened to catch some of that early sell-off and got filled first right here as it broke that first level of support at, probably 3307-ish. And then after it broke support, was able to kick in at about 3300 or so. So I got two legs on that. I actually did that on a much smaller time frame. I did that on a 15-minute chart. So here it goes. So caught the first move down, boom, and then as it did the little retracement here, the little boom, hiccup, retrace, I watched that little retracement form and then start to drop again. So I got triggered in. And the market, I thought, was going to rally, and it ended up trailing my stop down above the first pivot point. And I left myself a little wiggle room, and I tried to get my stop loss down towards that break-even point where I could have a stop. So after the market went down and closed, I ended up sliding the stop loss down to break even, down below that 3,300 mark, right above that pivot. And I was thinking, okay, the market might rally. If it does, it'll go up, it'll hit the stop. The hedge will be covered and would have a modest gain if it kept going down. Well, now the market overnight, I watched the market open on Sunday night, futures down. It gapped down. And futures occasionally gap down over a weekend, but not often. You see a really big, crazy gap like this. So again, you can see the big gap down on the daily chart there, where prices gap down below the 20, and we're seeing a big red candle. Now, we've been worried about this all along. This whole run up, we've been waiting and anticipating for a sell-off. Didn't know that it was going to be, punctuated and accentuated by, global fear out of a, virus coming out of China. Now, the market, there's the opening bell. So we've got our stop loss down, and I actually traced it down overnight to right above the gap, so that if it started to run above the gap, it would fill. It came and broke down even further here, closer to the cash open. Did another kiss goodbye and another drop. So I got the stop loss down below the last intraday pivot point down here on a 15-minute chart. And I'm going to continue to trail that stop loss down until the market reverses back up. In the meantime, I've opened up the portfolio, and the whole point of this is to hedge off the rest of the portfolio. Now, let me show you the beta-weighted delta hedge. Now, I'm going to beta-weight this against the E-mini S&P. We'll go back and do the before and after. So the delta here is showing 1464-ish. And then when I beta-weight it against the S&P E-mini futures, I actually managed to flip the whole portfolio bearish. And what I did is I sat there on Friday, and I went and I just tightened up stops, and I adjusted positions. I neutralized trades. I adjusted the options on a lot of the positions to reduce the risk and help lock in the gain, so that I could be beta weighted for a reasonably effective delta hedge. And that's working. Now the chart, I wanted to show you a chart of gold. And what we liked about that, gold was just coming down to an old support zone, new resistance zone. And I like gold setup just from a technical perspective for the bullish activity. And on Friday, when the market started heading south, gold was showing signs of bullishness. So I picked up a bullish contract on gold futures as it broke above these candlesticks right here. And we've got a little, upward momentum on that. So between the gold position and the broad market hedge here, we've got the portfolio pretty well battened down. That buys us time to go in and now surgically adjust and control the risk on the rest of the position. So I'm going to go through those real quick here and just see how they're performing at the cash open here. Let me get those kind of linked together, and we'll walk through and manually, take care of these positions. So we'll go start out here with the daily time frame. Okay, S&P hedge. We've got that. We got our gold contract. We got that. And now we're going to go through these positions. So Cirrus is a trade that's relatively neutral. They also have their earnings announcement coming out. And that is coming out on Wednesday. So we got that coming out on Wednesday, the 29th there after the market. And the position is a neutralized condor. And this is one of the adjustments I actually took earlier. I've had this on for a couple of, maybe a week or so, where I've neutralized this trade. Where this trade, again, started out as a bull called debit that was winning, and as the stock price popped, I turned it into a butterfly, and we got to reduce the risk down to 210. And the stock price has gapped back down here towards 80, so it's kind of gapped towards 80. Now, if it runs back up, this is kind of my profit zone. I've got the highlighted zone. So if this goes much lower, I'll just close the trade out, because it's pretty neutral. But if it starts to head back up, I can keep it, and it can stay in that little potential profit target. If this were to expire right at 90, it would make up to $2,500. So it'd be a really, really nice return. But in the meantime, it's pretty delta neutral. Our delta is just 20, and our theta's cooking at 4.5 on that. And so that's the other thing I worked on, is I built the theta up on the portfolio. We're up to 198 on that, and we had some of our other stuff expire. So we'll take a look at that. But there's positive theta on that. Now, I also took Disney, and I rolled the options down. I rolled the call down on Disney on Friday and took a modest gain on the 145 calls. Now, Disney, I know, is getting hit hard. I know that they did close they closed their amusement park over there in Asia, to be sure. And their stock price has gapped down below the 200 period moving average. And I was really expecting that 200 period moving average to hold just on technicals. When it broke down here below support, and I rolled the calls down from 145 down to, what do we have, Matt? 143. And so with the 143, we've got a nice little profit on the 143s. And we're protected on that. We've got a potential $666 gain. So as of now, the stock price is down here near the break-even point on the option, not counting all the other profits on the other covered calls and stuff that we've written, just on the stock itself, with the current set of covered calls. And so I'm going to keep an eye on that, see if that starts to fill the gap or see if that starts to fall. But I rolled the calls down on Friday. As I watched the market, breaking down, I thought that would be a good idea to roll those down. Next on our list is Facebook here. Now, Facebook is a poor boys covered call, or a call diagonal spread. Goes by a couple of names there. And this one I left on because the movement down in the price, which I watched, I saw that break support. I saw that. Didn't know it was going to gap down, but I saw it break and support crossing the 9-period moving average here. So I actually kept a good eye on that and looked at the graph, and I thought to myself, down's not a bad move for this trade, because the stock price was sitting up here a little higher. It dropped down to where it's at now. That's right at the peak of the maximum gain here, which would be up there near 1,000, $50 or so. If the stock price stays in that neighborhood. And it is also theta positive. So this one's bringing in a 1085 positive theta. Again, the delta is relatively low at 1.48 between the two options. We got a nice little $360 gain. And again, this particular trade in and of itself had a maximum debit outlay of 1651, 1654 actually, 1655 total. It looks like between buying the 195 call for June at 2170 and then selling this 215 call for the 21st of February. And that, again, when I was looking at these numbers before, was down on the short call, and I still am, but we're still up on the long call. And we do have an earnings announcement coming out on this one here on the 29th. And this one has a big Vega exposure. Our Vega is 21. So this one we probably, it really wouldn't hurt our feelings to take a profit on that. That's got earnings till the 29th. So I'll leave it on for another day or two because the volatility should still build here into earnings. But I got to close it by the 29th before they have that announcement. Let's double check that. It's after the market. Yeah, so I need to close that. I'll close that today or tomorrow just to make sure that gets closed before earnings. That'll help. Next on our list is our Kraft Heinz. We got assigned on the stock, and so it's showing a bit of a drawdown because we got assigned on the stock, and the stock price really isn't down that much. We also had the naked put and the short calls expire. Let me get that back to a daily time frame there. And this, pretty modest neutral, scenario here. We just happen to own 1,000 shares. So we want to start selling our covered call. So we'll go add our simulated trade here. And we'll go closest to 30 days. And I'll sell right now, with the market being as bearish it is, I'll sell a delta of 40. Let's see what kind of money we can squeeze out of that bid-ask spread. I might go to 31.50 here, delta of 35 with a narrower spread, depending on what I can get filled on here. Let's see if I can get that up to the 97 cents. Okay. I'll go ahead and do half of them at the $31 strike. I'll sell 5 contracts at 31. And then I'm going to sell 31.50s. I'll sell those as well. And this is just kind of, again, trying to do a partial covered, not full-blown covered. So let's see here. That's one more. I'll do 5 more. Let me edit those. Just make sure I'm splitting the spread. We can get up to 73 cents. Well, let's see if I can hold out for 75 cents on those. Well, that got filled right away. Okay, boom. So we got a pretty good little fill on those. That hedges us out for the next little bit with a little bit of premium coming in. Again, not counting for the other profit that we received. So again, owning the stock, got some nice premiums on the covered calls. We'll keep writing covered calls on that. Not too shabby. All right, next on our list is the Lockheed Martin trade. And I adjusted this one to try to reduce the risk. I adjusted this into a condor. And this started out with just a long call. And then I turned it into a spread where I got the risk down to $75. So I bought the 415 long call, $935. That started to win. Sold the 425 call, got the spread cost down to $75, maximum gain at $925. And I thought this one might have some potential still because it was still rocketing up on Friday. And I went and sold way out of the money option to get rid of the risk outside the probability cone, outside the gray. And did that, and that brought in, we basically got everything but $10. So it left us with $10 risk and a new maximum gain here at the top at 990 if the stock stays up there above 424. Whoops, I don't want that. 424. So 424 is about the 9-period moving average. Would like that. That'll work. So again, not a lot of risk in this trade, and I started getting rid of that risk because I was worried that the market was going to tank. Next on our list is low. This one was a high base breakout that I was hoping to get triggered. It did not. I'll leave that on there just for now because I can go back and clean it. That was just a breakout that didn't get filled. We don't own that stock. We don't have a position. I was thinking about getting into a position, but it never got bullish enough. So that's pretty cool. Next on the list here is Lululemon, which has been wildly profitable, covered call. And we'll take a look at their chart here. Lulu gap down. I actually really like this gap down. I think this is one of those buy the dip type of gaps. And with the covered call, let's see where we're at on that. We're getting closer to maximum gain for February 21st there. I might look to lock that one in. For now, I'm okay with the hedge on it, but I'm going to keep an eye on that look to buy back the call. We don't have to worry about earnings on this one. And this is one where the idea is you own the stock already. You got a big profit selling that 250 call. I want to make sure I lock in the gain on that 250 call so I can keep the $300 it's made. And if it comes down further, I'll roll the calls down. If it looks like it's going to fill that gap because it gapped down right into that support zone. If it looks like it's going to fill that gap, I'm going to buy back the short call and unlock the stock. Unleash the bullishness on the stock so that it can take advantage of a bullish run back up, because I think that's a good bullish setup. And if this fear is overblown and things subside fear-wise, I think there's an opportunity here for folks to buy the dip. And lots of folks would say, okay, I feel much more comfortable buying the market after a retracement than not. So looking pretty good. I mean, that's a discretionary decision, and it follows my rules. Just need to keep an eye on it. Next on our list is Merck, and this thing got beat down hard. And I just happened to take advantage of buying a put option on it as it got beat down. And it was winning on the put option. And I saw, again, that candle was getting pretty hairy on Friday. And so before the market closed, I decided to go sell an $85 option, and I got the trade risk-free. So we got a risk-free trade, no guaranteed to make $3, but it caps our gains at 303 if it keeps down. So keep an eye on that chart. And again, if the buying starts to come in, I'll close that. This one has earnings, but I have no risk, so I can leave the trade alone. So that's kind of what I was doing with the portfolio, was trying to get all the risk off as much as I could on positions. Now Newmont had a nice breakout. These are naked puts that are pretty darn close to maximum gain here. Maximum gain is 330. I'm just going to go ahead and put in the order to close those. I'm going to set in a pending order to close them for a nickel. I'll make that order good till canceled and send it in. See if we can get that one closed out. It may take it a minute to get filled out and closed at a nickel, but I don't have a ton of risk on it. Break-even point's clear down at 40, so I don't have to worry about that coming clear down below 40 all the way down here. I got plenty of wiggle room on this one, and earnings is not until the 20th, so plenty of time on that one. Next on the list here, so we've gone through Merck, we went through Newmont, Paycom. This is one of our big profitable back ratios that we just hit the home run on. And really nice big fat profit. Let me show you the risk graph on that, Paycom. And I actually ended up selling a bear call spread on the position. And there we go. Now you can see the risk graph. Kind of looks silly. It looks a little bit like an iron condor, but this started out with a back ratio, and I adjusted the ratio back from a 1/5. That's what we started out with, was a 1/5. And so we had this big back ratio, and we hit this big home run where we're up, making 16,000-17,000 bucks. It's pretty fantastic. And while that price was running up, I started thinking, oh man, this is too good to be true. We're just crushing it on this trade. Earnings is coming out here on the 5th. We got some time, but I went and turned it and balanced out the ratio. So I went from the 1/5 call ratio back spread. Again, this is a fancier trade. This is one of those big, swing for the fences. Best time to put this on is 4 to 6 weeks minimum before earnings. So you have, plenty of time to take advantage of the increase in volatility and a big directional. And, this was based off of this slowing momentum coming down here around this 200 period moving average. So this is a trade that put on way back here, and it just ripped up. Got lucky, took the first adjustment and tried to pull the risk off when it started pulling down here. So after we turned that, sold the 300s for 930. That reduced the risk. That reduced the risk and got the risk down to about $1,500 or so. And it shifted the trade more to theta positive, so that the trade became a theta positive time decay strategy right now. You'll notice it's pulling in 79 on theta. That's pretty good. And then I got the delta way, way, way down to 8. So we got that delta way down to 8. And part of doing that was I finally added on one more adjustment to this. I went and added on a bear call spread, a 5x5 bear call spread. And that put the top line maximum gain up at 19,365 if it stays between 300 and 350. So between 300, boom, and 350 out here. So right there, support on the moving average, and then clear out to 350. And I can close this trade at any time, but the point of it was I tried to neutralize the delta so we didn't have as much directional exposure. And that maximizes the theta, and this is continuing to work. And it's currently, again, $15,852 gain. Maximum gain on that's going to be about $19,000 and change. Again, $19,365. I won't carry that through to expiration, I don't think, because I got to close it before that earnings announcement on the 5th. So I'll let that time decay in the meantime work against that low delta. Next on our list is the Qualcomm, QCOM. And this one, this one's creative hedging. So this started out as a bull call debit spread. There we go. All right. Excuse me, I got a bit of a cold. Don't worry, I don't think it's coronavirus. This started out as a bull call debit, where I bought the 97.50 call and sold the 105 call, and had a maximum risk of 466 and an upside potential of 1034. And I did that because I thought Qualcomm had a nice breakout, and I caught that breakout, and I thought it was a good looking setup as it broke out, but then it started to reverse. So it was starting to reverse, and I was down a little bit, and I just thought I would do some creative hedging here. So one of the first things I did was I went and sold the $100 call and turned it into a ratio spread. And that reduced the risk to $160 and it leaves a naked call option on that, which had a break-even point, clear out at 106. So I only had to worry about it if it went back out above 106, because my original trade plan was an out-of-the-money debit spread. And I just went and sold. I picked the $100 strike price just because it was between the 105 and the 97.50. And so let's go find those real quick here. These are April's. These are longer-term options, by the way. So again, it started out with me buying the 97.50 and then selling the 105. And then as it started to drop and I was losing, I added this middle one. I added the 100 in the middle with the intent of going for the ratio. So I went and turned it into a ratio spread, which again reduced the risk up to 170 and brought in $1.53 credit times 2 contracts. Well, leaving with that $1.60 risk profile, I looked at the chart and I thought to myself, well, I don't think Qualcomm's all that bearish. It just happened to be a trade that ran against me. I just happened to catch the top, like this is where a breakout. I got faked out. I didn't catch the breakout. I thought this was a beautiful setup. Let me again kind of zoom in on that so you can see that. To my knowledge, it was looking like a really good looking cup and handle type breakout. I was like, woohoo. This trade's going to be great. I'm so excited about this breakout, and I bought out of the money call option, debit option, and then the mark, that showed up, and I didn't think too much about it the first day, second day, but then as it started to come down, on Fridays when I made the adjustment, when it was breaking down, and so again turned it into the ratio, which left me with this $160 risk, which is no big deal, for the portfolio, not that much risk. But I thinking to myself now, I already put the hedge on. I thought to myself after the pullback that it was still pretty bullish, and I went and sold this bull put spread for April, way out of the money, just enough to bring in $140. So I left myself with $20 risk in the middle. And again, point is this trade is not going to be a winner, but it's not going to be a big loser. The delta is down to close to zero, and it's going to pay $4 a day. And I can sit and ride it out in the meantime. There's no stress on it. So I basically took a trade that could have lost $466, and I capped the risk down to like $20, as long as it stays above 77 and below 106. So 77 clear down here at the 200 period moving average, and I went and made sure I got below that when I sold the credit spread. So I'm way down below that 200 period moving average, and then 106. So this has got a really wide area, and I'm just going to let that trade sit and repair itself. Try to keep the portfolio balance high, and at the end of the day, ratioing it changed the margin requirement a little bit. So I got a little bit of money tied up in order to preserve that capital. That was a little bit more complex, but kind of an interesting thought the way I just ran through that. And again, I don't expect you to understand all of that as of yet. That was literally just me. This is not a specific strategy. This was just me using some experience that I've gained over the years to say, oh, bull call debit going bad, sold the middle call, ratioed it. And I've done ratios on those types of things for quite some time. Which again just left us with an open-ended graph where it could go down, 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 and no risk, and only have $160 loss. And that out of the money put spread was pretty enough. Hey, got the risk down to $20 if it stays in that big old range, between 77, and I'll set that break-even point out there. Well, let me just do this. So let's set slices to break even by expiration, and I'll drag this one all the way down to that strike. I'll set those two on the chart. Yeah, I think that we got a pretty good chance of the stock staying in that ballpark for the next couple of weeks. It's got till April, and there's an earnings announcement. I may end up closing it because of that, but I don't have a lot of risk on it because it's got very, 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 very low delta, and the vega is negative, so the volatility crush won't hurt it, and it's got positive theta. Pretty cool, huh? All right, next is Restoration Hardware, and this is another one I ratioed. And this was a bull call debit. So let me analyze a closing trade on that. Just show you what we had on that before. And I'll set that up at 590. Just so it takes that out of the equation. So this was just a bull call debit, where it had about $400 risk and about $600 reward. And it was just a bull call debit. Hey, I think this is going to, pop up and run off of this pullback into the rising moving average. And I thought this was a pretty bullish looking chart. So I took a bull call debit spread. Well, as it started to run against me, I sold a second 270 call option to ratio it. And now that leaves the break-even point above 190. So now this trade went from being a bullish long call, turning it into a ratio. That's kind of my fancy trick. Just sold the second 270 call and brought in some premium for that. And so I think that I can't remember what the original 590 is, the new averaged cost between the two options. But that leaves us with a really cool situation where I can set the slices to break even here, where this stock, all it has to do, and this is an option that's good clear through May, because I went long term on those, just needs to stay down below 280 out there, like 280 ballpark, in order for this trade not to lose with the way it's. And so if the market starts to run up, I'll probably close it early. But in the meantime, I turned it into into a ratio so that it does not have risk if it drops to the downside. Literally, this will walk away with a $190 gain if it stays down below that 280 line. And so, hey, I can keep an eye on that. That'll work. Next on the list is Target. Gap down early before their earnings announcement. They still have that earnings announcement coming. It's looking more and more like it's slowing down into a support zone. So this one may find some strength. If we got folks buying the dip here, that could work out well. This one just had naked puts on it. And the puts were doing really, really well. And I already had the margin tied up. So I went and sold some calls on it after it gapped down, so it would get me a little bit more theta. And that didn't really increase the BP effect much at all on Target. So we got $3,755 tied up total. We're pretty neutral on the delta. Theta's cranking at 7.6, and we're up $444. So this is a short strangle, and in order for this one to win, let me set those slices to break even. Set those to chart. I need Target to stay in that window. So those naked puts were way below the 200 period moving average and way down there. So I feel pretty good about those. And again, they're good through April, but that's an awfully wide berth, even for a clear out to April. If you look at where the April options prices are, that probability cone's way inside my range, so I can keep that short strangle on. That's just naked put out of the bear naked call. Short strangle. If it starts to run up, I'll buy 300 shares of Target. If it's, we're in good shape on that one. So, boom. All right, we got filled on our NEM. Let's see what that did to our NEM. Did that get us out? No. There we go. NEM. Yeah, that took us out. We're flat. Cool. We got out early on Newmont. Nice. Okay. Next, TJ Maxx. 300 shares. Sold covered call on it. This is pulled back down. I think this is kind of a buy the dip scenario at this point in time. Keep an eye on the broad market. But got a break-even point at 59.34. Tell you what, if that breaks 60, let me know. I'm going to create an alert. At or below 60. Time to roll options in the money or close the trade. Okay, so if it goes below that price, it's going to alert me. Otherwise, leave that trade alone. UCO. This is now short calls. It started out with short puts, and it broke down, and I had it on the bear calls. And when I looked at this, I thought, oh, that oil's going to keep on running. So I just got rid of the naked puts and left the short calls. So it started out again, naked puts. I added on the short calls after oil started breaking down. And then I watched the chart of crude light. I thought, oh, that's got a ton of downward momentum. I didn't expect it to find support till 14. Let me show you the actual crude light itself. This is the UCO ETF, the double leverage ETF. There's the chart of crude. So it's coming down, down, down. I didn't expect it to find support till 52-ish. So that's what I was shooting for. And but it was getting so bearish the last couple of days. I just thought, well, I better get rid of those puts. And so I just got rid of the naked puts. And UCO left on the short calls. So those can make 240. And that's going to end up being a small expense at the end of the day. Not a major expense, but it was just good to get rid of those. So next on the list, XLE. I shorted the XLE, got a trail stop. Working on that. This is just 100 shares. So no risk. Stop loss is down, way down below at break even. And just letting that one run. And that's just playing that same oil short, and I think it's going to keep running. And then ExxonMobil, last but not least, this was a naked put position. I added on some short calls to collect it as the stock chart got more bearish. So it was just, originally it was a naked put. Didn't mind owning it. Was going to look around, writing covered calls on the dividend payer. It's got earnings coming out, so I probably do need to close this out prior to earnings. And where we're at, we're down 374. When do they announce earnings here? Not until the 31st, so I got a couple days till earnings. In the meantime, I'll let the time decay work. The delta is really low and neutral, and that theta is positive in the Vega. Yeah, well, that won't hurt our feelings too bad. That takes care of the portfolio. So there you go. That was basically the market opening bell routine. That took me about 30 minutes to go through the portfolio and manage it. And again, part of that's just making sure I got the hedge in place. Let me double check my stop loss on the hedge. Very cool. Okay, let me take that intraday. I'm down below the pivot. Oh, we almost got stopped out on that. Pretty good on close to hitting the stop loss. Now that that's heading down again, that's actually a pretty great placement for our stop loss. Because my thought was, after this move down, I don't know how big of a deal the China norovirus is, and the market got spooked, but I don't know how dangerous the virus is. I mean, I've read up a little bit on it, and of course there's always the human tragedy involved. I'm speaking on it from just a market perspective and how we're looking at it as it's a disruptor. It causes economic slowdown potentially. So I'm not sure how well the market's going to react, and if we're going to just see a buy the dip or if we're going to see a bigger panic. But in the meantime, we actually have that portfolio hedged to the bear side. So I have basically bought time. I got that trailing stop, and that profit right there, that's keeping our income up. It's protecting, it's padding that bottom line stat. And again, we closed other positions and locked in gains and other things, so we were up almost $40,000. And just in unwinding some of the profitable positions, last week this was down to about $33,000, and then we got a couple of other options expiring, and some of these obviously you can see where the P&L for the day overall, we're actually up on the day after closing a bunch of positions out, locking in the gains. So that was just an exercise in the opening bell, and really the big routine here, the big kind of takeaway that I want you to see is I was checking those futures Sunday night. That's one of the first things I do in Sunday afternoons here. I always just remember to check the futures, see where they open. And so I knew that the norovirus thing was hitting the market, and I knew that that's where we were as of Friday. So I was wondering if that was going to get bigger and bigger. And I watched some of the news stories, and I could see where it was spreading. And it's out in other places. They have confirmed cases outside of the China. We got some here in the U.S. So I thought that the fear contagion was pretty reasonable. So that's why I had that, part of that hedge was already on just due to Friday's activity. The whole hedge, excuse me, was on because of Friday's activity, and I didn't know the market was going to gap down. But I felt pretty comfortable going when the futures opened up down. I knew that I was covered. And that was just me being proactive and Johnny on the spot. Now, hedging with futures, that's a lot of leverage, and so that's why I legged in. I actually got up profitable on the one leg before I added the second leg. Then I trailed stops, and I just kept trailing the stop on it. And the reason I'm trailing that stop is because that little negative 100 delta, well, that's a lot of leverage for those two futures contracts. And again, it does manage our portfolio in the meantime and hedges off that risk. And it bought me time to go in and surgically manage the rest of the positions like we did. And, it's not a stressful moment where lots of people out there might be stressed. I'm pretty calm and collected here this morning, just trying to, keep up with that. Looks like we're giving up some of our profits on that gold, on the gold futures too. I need to make sure I get the stop loss in on that. So let's see here. Gold futures. Let's go /GC. Break even at 1573.10. 1573.10. 1573.10. Let me double check that number. 1573.10. That's the price we got filled at. 1573.10. Make that a stop order. Make it good till canceled, and that's a break-even trigger on that chart. So if it heads down below today's candle, and I caught this a little late. I caught this on late on the day, Friday, before near that high actually. So if it starts to reverse, we're out. If it keeps running for us, we're in good shape. So we got that one. Stop loss at break even. Okay. That one feels pretty good. Well, that was fun. Now we've got time for another lesson, which will come back here. I'm going to take a quick break myself, and I'll be right back, and we'll come out. We'll do a new lesson. So we'll talk about some new concepts for you. Hopefully you found this early morning, right at the opening bell routine, trying to react to the futures being down, manage the risk and the coronavirus. We'll come back here in a minute, and we'll come up with a good topic for us to peruse. Okay, so we're back. It's a little bit later. A couple hours have passed since I did the recording this morning, and the market's kind of rallied a little bit. And it's a pretty good example of, what the markets can do. And what I thought we'd spend the rest of our time talking about this week is, what to do in the future if the market were to do something like this again, sudden movement overnight, gaps down, or something like this over the weekend where you have a, unanticipated reaction to something as dramatic as we're seeing right now, again, with this coronavirus. So I think the market initially, has overreacted. And from the news headlines I've been reading, it sounds like they've got things under control. Things are mostly contained, and that it's not as horrible as everybody was worried about. And that's typically the case when fear grips the market. Now, of course, that could escalate. Most importantly, our hearts and our thoughts and our prayers go out to those who are affected by this. These types of things. Nobody likes it when these kinds of things happen. They can certainly affect people, in real life. And of course, in the financial markets, the markets can respond to these types of catalysts and contagions. So we're going to talk about what to do when the market gaps down. And the first thing to remember is simply remain calm. Don't overreact. Don't panic. The market can panic, but it's our jobs as traders. It's our job to stay calm and to stay collected and to be the calmer and cooler head. And one of the easiest ways to make sure you're doing that is just making sure you're not over leveraged on your portfolio. You always have a good position sizing and stop losses. And in theory, in worst case scenario, is we get stopped out, out of the bullish positions. Let me make sure we got that. Which is really important to make sure you've got those stop losses. Now, when the market, showed the first signs of selling pressure on Friday, I went and adjusted stops. I adjusted positions, changed the positions to reduce the risk, to neutralize positions, to avoid potential, because the market was really, really overbought. And I think a lot of people were already asking where the top was before this catalyst came in. So that's, something you want to make sure you do. And again, one of the things you really want to make sure you're doing is you want to make sure that you're not putting too much risk on per trade. So, if your maximum risk per trade is 1% of the portfolio, then you can go about calculating the total number of positions. You can predetermine total number of positions, and you always want to keep your portfolio risk to somewhere between 5% and maximum on the high end 10%. So that means in this situation, if you had a maximum risk per trade of 1% of the portfolio, and then if you had 5 positions on, 5 positions at 1%, well, that would equal, 5% portfolio risk to your stop. If you had 10 positions at 1% risk per position, that, of course, would equal 10% of portfolio risk to stop loss. And that's really, really important to make sure you've got appropriate portfolio design from the get-go so that you're not overexposed to risk. And, in this case, we were operating from a pretty profitable situation where we're, last week we were up 30-something odd thousand, dollars, almost $40,000 before we started closing down positions. So we were operating from a position of strength. And, when that's the case, you just want to make sure that you're not over leveraging your portfolio. You predetermine that maximum risk per trade, and you're always cognizant. It's also important to note that there were warning signs, heed the warning signs. And, we had warning signs several days in advance. In this case, we had signal candles. We had slowing momentum on the chart. We had signal candles. We had the break of initial intraday support, showing sign of reversal. Okay, and so we had small signal candles and then big signal candles. So we actually had small candles, long upper shadows, and then we had engulfing bearish reversal signals. So let me go just show you the chart real quick here and just kind of point out what we're talking about. On the S&P, the warning signs were really clear. And again, the market had been going up and up and up and up and up. So let me really zoom in on that so we can really spot that. Okay, so I'm trying to manage the space at the bottom so we can keep that closed captioning on for you. Okay, did I get all the way? I got all the way over. There we go. Okay, so what we saw here, when I say slowing momentum, is that the candles started to shrink. So we had big candle up, and then these smaller candles up at the top. And then we had a red candle. That's kind of a hangman with a long lower shadow. That was a warning signal. Then we had this candle, which had a long upper shadow. And what that means is it tried to pop, and then it failed. And then it actually started to break the candle lows. And on this green candle, that was the first sign the market got spooked, but it hit that 9-period moving average. And it ended up rallying back up, showing signs of strength, but it still had that long lower shadow, which is kind of like the market showing its cards a little bit. You had the long shadow here, which showed some selling pressure. that long shadow up here, which showed some selling pressure, and then you had a long shadow down here, which again, even though it rallied, just saw some selling pressure. And so that's kind of like a poker player showing their hand a little bit, or giving their you can tell they're bluffing because of their facial expression. Like you can see that little tell. And then here on Friday, boom, we had the big bearish engulfing. And when it started to break intraday support and candle lows, that's really what forced me into hedging. And I didn't really get hedged. I pulled the trigger on the first hedge at about 33.07. And then I added the second hedge as it broke those lows. So let me take that down intraday and show you how that kind of played out, where, you can actually see here. Let me back it out and we'll go like 20 days, 1 hour. You can see the actual triple top forming. It's not just a double top, it's a triple top where you can actually see the M, the kind of the M for murder showing here. Let me get a good pen color here so you can see that. So you had that triple top, boom, and that's stock in a box. And of course, that could break out to the upside, but when it broke to the downside, we had a very, very clear signal on Friday. So that's what I ended up spending my time doing on Friday afternoon. Is I saw the initial heavy selling pressure on Friday morning. And again, a lot of this was in response to news. And when it started breaking the first key levels of support, when I put in a threshold right about here. So by the time it got down to 33.07, I was already triggering into my first position on the short. And then I added to the second one, and I ended up getting cost averaged into about 3,300-ish. We got stopped out. But those were the warning signs. We want to heed those warning signs. And again, I didn't know the market was going to gap down. And I actually had put in a trail stop, and I had put in a trail stop, and I got the stop loss down to break even, and I just laid off of it. And I was actually thinking it was going to run back up and get stopped out, that the market, nothing, that was contained, everything would, go back to normal. But then, of course, the market did escalate a little bit to the downside, and we had a gap down on the futures. And so, again, I watched those futures on Sunday evening. So that might be something we add to our list here, is to help you with, heed those warning signs. Keep your finger on the pulse of the market. Keep your finger on the pulse of the market by watching the futures indexes. Or index futures is probably a better way of putting it. Index futures. Hopefully this is helpful, by the way. And then, you as the market opened this morning, you saw me go to business, managing the trade. So, I had already started neutralizing. We want to work on closing and or neutralizing bullish trades at the first, signs of reversal. So, I started exiting profits, lock in your gains, lock in gains, and mitigate losses. Okay, so that's, we want to make sure that those are the things that we're doing. Now, first thing that I went to business doing was, doing things like rolling calls down, adding bear call spreads. You saw in the little trade management section I did there this morning, where I was going back and showing you how I, threw bear call spreads on, or I turned them into ratio spreads. By taking adjustments. Now, those are more advanced skills. A trade adjustment is more of an advanced trade. We'll just say stop loss is, beginner is simple. Okay. Adjustments are more advanced. And that requires skills, practice skills. Okay. So you got to make sure you're, doing that. Stop loss is always the simplest answer. And then adjustments require, more skill set. So do what you're comfortable with. Don't try to do the fancy adjustments that I do until you've learned them or practiced the idea. Stick with the simple stuff. Just simple stop loss can be really, really, really effective. Now, the other thing in part of remaining calm is just not panicking. And I was actually kind of worried the market was going to tank But let's take a look at what it actually has done since. Let me drop it down back into a 15-minute chart. And I ended up trailing the stop loss, as you saw this morning, all the way down to these higher pivots. And the market ended up coming back up and hitting that stop. It put in a higher low and ended up hitting the stop on the option on the futures contract. So we got stopped out at a $3,925 profitable gain. We actually were up almost $7,000 on that hedge at the lows, but walked away with that $3,925 gain. We still have our gold contract on with our stop loss. And if I show you that chart on the daily chart, you'll actually see now it's got a long lower shadow. And this might just be enough to encourage some bulls to buy the dip. Now, buying the dip can work, and it can work consistently until it doesn't. And I'm a little hesitant on this one because of the news surrounding it, and again, the potential for it to potentially escalate again. The market got spooked, and again, at the end of the day, the coronavirus might be nothing, and might not be that big of an economic disruptor, and the market's knee-jerk reaction might have just been that knee-jerk reaction and overplayed, and it comes down to the bottom of the channel. People buy the dip, back off to the bullish races. I don't know which way this is going to play out. So at this point in time, I'm mostly interested in the gap zone. So I would basically come in and say, well, hey, if this starts to cross the gap zone, I need to know. So I'm going to go put an alert on that. Hey, let me know. We'll go create alert. If it's at or above 3027, we'll go with S&P futures, filling weekend gap. Potential bullish signal, potential bullish signal. Okay, so I've got that alert created. Now, I also want to know if it takes out the low. If it takes out the low, I need to set out an alert there as well to keep me, again, because I can't sit in front of the market all the time, just like you. I get busy. So we'll go create an alert here, and we'll say, hey, if this goes at or below, okay, market, S&P futures breaking daily candle low, Monday's daily candle low, post gap daily candle low, the bears are out. Okay, that would be a signal to me that we're seeing more bearish sentiment. And part of what I'm looking for is that on that daily chart, as I zoom in here, there we go. We can see I've got, alert above, alert below, and I don't know which way it's going to go. And whenever you cross moving averages, like you cross, below the 9, it has a tendency to, fill the gap. That creates a gap void, and it'll go down to like the 20. And if it violates the 20, that creates a gap void, and sometimes you'll see it drop all the way to the 50. And so those little empty pockets between moving averages, it's really, really common for them to kind of play out. So I just watch for that. And then I'm watching if this dips all the way to 3,200, at which point in time I might want to set another alert. So again, I'm not a fan of really panicking first thing in the morning when the market gaps down and freaking out, because there's a good chance that a lot of these trades will fill their gap. And if you go back and look at like some of our candidates here, and again, we go look at our current account positions and we look at like, CRES, for example. Well, okay, this gap down, but it's already starting to show a hammer style candle. This morning, it was just a doji hammer style candle. And that's got a good potential to fill the gap. And so, had we panicked and closed that trade out early, we might have missed that opportunity to fill the gap. So that's the other thing we're going to have to watch out for is, let me bring up that notes and we'll go, watch for gap to fill. So, stay calm and watch for signs of intraday reversal and potential gap fill. Traders like to buy the dip, and that's been kind of the modus operandi for the market. They've been buying the dip. So those are things that we work out. Now, the other thing we want to do is we want to be, equipped, have a game plan for portfolio insurance. Using options or Um, Options for beginners and futures for advanced traders only. Be careful with the leverage, and it's important, and always use a stop loss on any hedge taken, because those futures, those two contracts, if the market had all of a sudden ripped up and been reversed, and I did nothing to it, I have a ton of leverage to the bear side, and if the market kept going bullish, my hedge created more of a problem than it solved. So have a good game plan, and this is where things like learn how to beta weight your portfolio and identify how much insurance is needed have a plan for portfolio for scaling in. I'm going to change the plan for scaling in into portfolio insurance. And once you have, how much insurance you need, start scaling in small. Okay. We'll give an example. That's just work. Just scale in. Like if you needed 3 contracts, start out buying 1. And then if it keeps going, add 2. And if it keeps going, add 3. Just start with small with your insurance at the earliest signs. Because a lot of times that first little dip in the market just dips a little bit in the market, rebounds and runs right back up. And then once you've got risk managed, existing risk managed, that's when you can go about looking for new opportunities to trade. And a lot of times with a gap down, the opportunities would be, look for naked put or bull put spread opportunities. If market shows signs of rallying off the dip. After the market takes the dip, the first, maybe it only lasts for a day or two, and then, some good stocks get set up for a good buying opportunity. And there'll be an opportunity to buy the dip, but you have to wait for confirmation. This is super important. Wait for confirmation. That's really, really important. And then if the market turns more bearish, okay, look for bearish trading opportunities. And you might start out with less aggressive. Would be things like bear call spreads. Bear put debit spreads. Short stock or long puts, more aggressive. So less aggressive, moderately aggressive, and then aggressive. Hopefully that little bit of information there, just kind of notes for you, are helpful. And if you want to, take some screenshots of these notes, by all means do that. Let me go ahead and give you, the first part of it and let you take a screenshot of that. I guess we should probably put our words correct, predetermined. And then let me go ahead and scroll down so you can grab the rest of the notes. And there you have it. Hopefully this week's Mentor Club was fun. Hopefully it was informative. Hopefully it was helpful, and that you learned a little bit about how we approach the market. Again, this is an exciting opportunity to learn, and I had a lot of fun teaching it to you, and I really appreciate hanging out with you. And I look forward to spending more time with you next week.